This video is going to just go over some of the review questions out of Chapter 1, which is the demand for audit and other assurance services in auditing. So won't go through all of them, but we'll go through some of them. So the first one asks, what is the information and the established criteria for the audit of a tax return by an internal revenue agent compared to what about the audit of the financial statements? So it could be the same CPA firm that's doing those, but again, it's the criteria that is different. So if we're auditing the tax return by an IRS agent, they're obviously going to be going back to the Internal Revenue Code and the tax laws to verify that the person is in compliance with that tax code and those tax laws. And again, that would be done by an IRS agent. The tax return could be done by the CPA firm, but the audit would be done by the IRS agent. The audit of the financial statements of that same company, those are going to be going back to generally accepted accounting principles to verify that the financial transactions are all in accordance with GAAP. So again, it's you're still taking a basis of information provided by that client, but then it's what you're comparing it to. So with the tax return, it's going to go to the Internal Revenue Code, and then with the financial statements, it's going to go to generally accepted accounting principles. Then our second question asks, okay, in the conduct of the audits of the financial statements, would it be a serious breach of responsibility if the auditor did not thoroughly understand accounting? So yes, that would be a serious breach of responsibility because again, we're taking this financial data provided by the client and we're comparing it to generally accepted accounting principles. So we need to know those generally accepted accounting principles so we can make a good decision. Then it adds, okay, well, many competent accountants do not have an understanding of the auditing process because auditing is just a specialty in accounting. So obviously not everybody is going to end up being an auditor. It's just one branch of accounting. So auditing itself is setting up the what type of sample size am I going to use? What type of financial data am I going to pull so that I can double check this data to make sure that it is in compliance with generally accepted accounting principles. So the auditor has to have the knowledge of preparing proper audit procedures and again determining the size of the samples and what type of items they're going to test. And those are things unique to the auditor. So an accountant who works in that company may kind of know the overall goal of the audit, but they don't understand maybe all of the details of the audit procedures themselves. So again, it's just a kind of a branch of accounting. Okay, then next thing asks, what type of changes have we seen in accounting and business operations over the past decade that have increased the need? So as we become more technological and businesses become bigger, so businesses are acquiring other businesses and they're getting larger and they're spreading across geographic areas, all of a sudden we have just tons and tons of data. So that makes it much harder for that auditor to say, okay, well, what is my sample size going to be? If there's just millions of transactions, how many do you have to really test so that you feel comfortable in that you're saying, yes, these numbers do accurately represent what happened in that company. So just that volume of data and knowing how to sort it and how, what's the sample size and how to judge it, as well as just more and more complex transactions. As companies become international, they may be doing business in euros or in pesos or in francs, all different currency. And you'll learn this in advanced accounting, but there's a translation rate. So you have to translate those transactions that happen in that foreign currency back over into the US dollar. And that can impact it depending on how much the US dollar is, worth in the market at that time. So again, that can make things more complex. And then again, just if people are doing business all across the country, can the auditors really go to all those sites? Can they travel to the different locations to maybe talk with those managers of those areas, or the people who are actually performing those tasks? All those things make it much more difficult to conduct these audits. Okay, then it gets into our 3 different factors that impact a loan interest rate. So the risk-free interest rate, that is basically just set by the government T-bond. So our treasury bonds are considered our risk-free rates. And they are, if you were to look at those as an investor, they normally pay the least amount of interest. So that's what we consider like as risky as our government. And so basically it's a risk-free rate. Then the banks are going to adjust that, bringing it up, based on the business risk of the customer. So if the business is risky, say they're in, like a technological field that is constantly changing, that might be considered a higher business risk because there's increased competition. As technology changes, their product could become outdated. So maybe like software businesses, they're going to have a higher business risk. Now then, say you're a utility company and you're a power company that sells electric power across the United States. Obviously, that's going to be less risk because there's not a ton of competition and there's not a ton of change in that industry. So that business risk is basically just, are there factors that impact their business's ability to pay that debt? So that could increase it. And then information risk talks about the accuracy of the information that is provided to make that business decision. So if you're getting audited financial statements, that reduces that information risk. If the statements are simply reviewed by the auditors, that might increase the risk. If the auditors were involved and you're just looking at financial statements provided directly from your potential customer or the person trying to get the loan, obviously the information risk is going to be higher. So the key to the audit is that it can reduce that information risk for the client that's trying to get the bank loan. Okay, then our next question asks, identify 3 ways that that information risk that I just talked about could be reduced. So we've got that the user verifies the information. So that would be the bank themselves. So the bank themselves could go on to the client's location and do a thorough audit themselves. So that's really not going to happen with a bank or a bank loan. What it gives examples of is, like, say you're getting an audit by the IRS, that IRS agent will come on location and look at files firsthand. So that is an example of how a user verifies that information. Or if companies are in the business of buying other companies, they will do what they call due diligence. And then they too will go on to that business's location and they will look at records for themselves and potentially maybe not involved an outside auditor. The other way is that user shares information risk with the management. So what the user, the bank, would say is, okay, well, you're going to be liable. The management of the company is liable if any of this information is not accurate, and the bank relies on it and they end up losing money. So basically what that means is the bank would have the right to sue the company's management. Then the third way, and what is the most common way and what we're really going to focus on, is the audited financial statements. So we get an independent auditor in who reviews those financial statements to ensure that they are prepared in accordance with GAAP, and then the bank relies on those audited financial statements. So that's pretty much the main way that big businesses do business and get their bank loans. Okay, then when we talk a little bit about the different types of services, so we have an assurance service is when an independent professional comes and provides a service that, again, is going to identify the quality of information that they are provided, and they're going to report back to those decision makers. So again, that's pretty broad. So that can be a wide range of different types of services. So inside of that, or under that umbrella is attestation services. Sorry, I always stutter on that one. So the attestation services is the audit of the financial statements. It could be audits of the internal control procedures that go over top of the financial reporting side of the company. They could review those financial statements, and then there can be other types as well, but those are the most common. So again, an attestation service is where the audit falls under, but that also falls under the assurance services. Then you could go back to the table in the textbook. It gives you other examples of assurance services. So like they say, mystery shopping is an example, compliance with different royalty agreements, if it's ISO 9000 certifications, which would be more on your production side. So there's a wide variety of different things. Or even if you watch like those judging shows, so like the Miss American pageant or the lottery drawing, those are going to be where there'll be auditors who are independent of that process, and they're going to factor in all the votes and determine who the winner is. And again, the key is that they're independent. So all of those are examples of assurance services. Okay, then let me keep going down. We can also have, so looking at our different types of audits, doesn't specifically ask us this one, but it's in Objective 6. We can have operational audits, compliance audits, or financial statement audits. So an operational audit is identifying whether the company, like evaluating the company's efficiency and effectiveness of any part of their operating procedures or methods. And then, so again, you could just look at, it depends on what it is, you know what I mean? You could look at their payroll processing to see, are they living up to those standards, their shipping procedures, kind of anything within the company that the management would want to verify that what they are actually doing lives up to their operating procedures. A compliance audit is conducted to determine if they are following specific rules or regulations that are set by some higher governing body. So maybe, again, if we look back at like our payroll, are we definitely paying minimum wage? Are we paying overtime when we're supposed to? If we look at our bank loans, we normally have debt covenant agreements with that bank. Are we living up to all of those? Are we complying within those standards? And then the financial statement audit, again, is just to make sure that our financial statements are prepared with generally accepted accounting principles. Then when we talk a little bit, then in the last part of the chapter, we talk about the CPA exam. So the CPA exam, again, it differs depending on the state that you're in, but it does give, and the 4 parts are changing, or they're going to be a little bit more customizable. So that's a change that's coming up in the future. But basically speaking, the requirements to become a CPA, you obviously need your education requirement, which is currently at 150 credit hours, which kind of puts you up at a master's degree level. Then you have to sit for and pass the CPA exam. And again, there's going to be different sections in there. There's the financial accounting and reporting. But then we're going to have some, in business environment concepts, we're going to have some differences with tax and data analytics. And there's going to be some changes that kind of come into play over the years. Then there's always an experience requirement. So a lot of states require 2 years of public accounting. Some states will push it higher if it's private, or if your educational requirement was not met when you passed the CPA exam, it might require 4 years. So there's different state laws that kind of govern those. And again, those do change periodically. So that is kind of chapter 1, going over those review questions.